welcome to Super Stonk Brothers, episode number 3. Hey, Steve, how you doing?
I'm doing good, man. I'm ready to talk about our company of the day. What's it going to be?
So today we're going to be talking about Tesla and specifically how you should be thinking about the potential for growth and the valuation for the company. And in fact, ARK Invest recently, about a week or two back, released a new price target for Tesla, which at the base case was $3,000 per share by 2025. So a significant increase from the current price, which is somewhere in the low 600s. And so what I wanted to do in terms of the format of the discussion today is talk about ARK Invest model, like how did they get to such a high price target for Tesla? Talk about how people are thinking about the way to value Tesla, right? There's different schools of thought. And I think that, and for me as a lazy investor, for anyone who hasn't seen the way in which I invest, I generally try to invest by proxy, meaning that I've got a full-time job. I don't have time to go into the weeds in research. I'm not going to be able to compete against full-time research firms. So what do I do instead? What I do instead is really don't try to go into the details, but understand what are the key assumptions being made. How are people thinking about the way in which they're viewing a company, valuing a company? And so by understanding the way, the approach, the philosophy, and not getting too much into the weeds, I would then assume that they have research analysts, whether it's ARK or what the other big, institutional investors.
Probably smart people, right?
They're taking that approach and they're doing it in the appropriate way.
Yeah. And if anybody wants more details about Joe's method of investing, I believe you talked about it in episode 2, right, Joe?
That's right. Yeah.
You went into it in more detail.
Right. And I think besides that, and why people should be listening to us rather than a lot of the other folks who may be on YouTube providing research or insights, is because I also wanted to provide a little bit more of an operational framework or operational insights on why you should be thinking about Tesla as in my opinion, incredibly dominant company that you just can't get from looking at spreadsheets and financial analysis and things of that nature. So, but maybe we could start in terms of where are you at with Tesla, Steve? What are your thoughts in terms of the valuation? The company?
I'll tell you, man, like I'm long Tesla and I resisted for a long time until about 9 months ago when I finally just broke down and decided I just can't bet against Elon anymore. Like it's not like I was shorting him, right? I wasn't doing anything like that, but I was sitting on the sidelines and I was just watching this guy through force of will, seemingly, and plenty of BS too, like skillfully applied BS. Pull his company from what appeared to be near insolvency through to positive cash flow, right? And I suppose you could call it profit too, depending on how you feel about the way they do accounting and stuff. But they had kind of a brush with near death a few years ago, trying to get the Model 3 out the door.
I think multiple times.
Yeah. And each time, Elon Musk has managed to basically hydroplane and bounce off the ocean, and gain altitude. And now it seems like the company is very unlikely to tank again. And from here on out, it's in a much more stable position, just in terms of the technology, in terms of the market available, in terms of Tesla's ability to continue to lower the price on their technology and expand the market. I think that we've gone from the bear case of Tesla just falling apart completely to a neutral to bull case looking a lot more likely because they've gotten through kind of the growing pains stage is what I would say. And so, I bought last summer and I'm up, let's call it 150%. And I'm holding.
Right. Yeah. I am an extreme bull of Tesla. So it's my number one holding as well as my kids' fund. They own in their fund, they own 50% Tesla. I just think that I actually don't think that Elon is so much of a bullshitter. I think that he believes what he says, or at least that's what I think. But I do think he is quite possibly the world's greatest CEO, and I can go into the reasons why I believe that. And if you're a long-term investor, and that's one of the things that I don't care about, because when I buy, I try to buy and want to buy forever.
Right.
That I don't really care if he misses in terms of, oh, he wants to get so many gigafactors up by this date, or, whether full self-driving will be there in 2025 or whether it's going to be there in 2 months from now. I mean, I just really don't care. But eventually, when you see the stacking of these capabilities, that people just fundamentally underestimate scale. I mean, a great example of this is just look at the growth of PayPal from when it first launched to, over time.
Yeah.
Like,
holy crap.
Yeah. Or even just, messaging and like the growth of things like Slack, for example. And these markets are just fundamentally, and the impact of technology, people, and this is the lesson I learned, because I've been an idiot for so many years, trying to time the market and understand the technology adoption lifecycle and how disperses through the world, and when and how value is created from these things is hard. But the longer term trends is something that is easier to predict and to see. But the market timing of it is, in my opinion, impossible.
Yeah.
By the way, can you see my screen here?
I can.
So for me, I think Tesla will become the world's first $10 trillion company, although more like
Spicy.
in 10 years.
Very
but
spicy.
It'll be a combination of the value that they create as well as the devaluation of the dollar. So I've got that second part to help me with that.
Well, hey, I mean, they're already accepting Bitcoin. So it's like in 10 years,
Yeah.
the dollar's failed, then they'll be in a great position, right? 10 trillion Bitcoin.
So let's look at ARK's price target for Tesla in 2025. And I think before we jump into the weeds on this, we should first talk about, first of all, how do people actually what are the high level ways in which people value companies today?
Right.
And when we look at this, there's basically a few models out there. First is a discounted cash flow model. Let me show you an example of that. Discounted cash flow model means that you try to estimate or forecast what the free cash flows of a company are going to look like over a period of years. You then estimate a terminal value, and then you basically discount these cash flows based upon your view of risk for the company. And that gives you the DCF, the discounted cash flow value, the net present value of the company.
And this is good for more stable businesses, right?
That's right. So companies where you can accurately predict these cash flows, this is a very good way of doing it. And for businesses which are understandable and that exist today. Now, this is the problem. All the old school guys, all the traditionalists, the people who are out there valuing companies against this model have an expectation in terms of a TAM, a total addressable market, competitors in that TAM, and relative market share against this existing market. Now, where this type of model breaks down is, what if you have a new market, like a full self-driving robo-taxi market?
Sure.
Or something else that we haven't thought of, right?
Automated insurance is another one, right?
Yeah. These new markets, these guys, the way that they think, and again, as a lazy investor, again, I don't care about the minutia of the analysis. I care about, how are these guys thinking? How are they getting to their understanding of the valuation of these companies? And so when you look at some of these guys, and so, I was just doing a quick web search on Seeking Alpha, looking at the people who are shitting on Tesla, right?
Right.
And you can see the way that they're thinking, right? And so here, I believe that discounted cash flow is the best way to value a company. No, in a market that you have no idea. So like you can
no.
you then understand, why are these guys failing? Why have they continued to fail and not been able, these are the guys who've been shorting Tesla for so many years and just getting their asses handed to them, basically, right? Or like, and so you go and time after time, you see like, these guys that talk about why it's unrealistic, why they don't believe in Tesla.
With their migraine stock photo.
Yeah. And because they're doing comparisons against existing markets, existing competitors. So here they're like, look at the valuation, market cap per car sold, not electric vehicle sold, car sold, right?
Yeah.
And so here you're like, okay, well, compared to existing markets by GM, Ford, Fiat, Chrysler, like the way that they're comparing these companies, and like the market cap of Tesla relative, they're more than all the existing auto manufacturers. Yes, auto manufacturers. So if you look at Tesla as a auto manufacturing company rather than as a transportation company
and energy company
or potentially in the future an e-commerce and last mile delivery company or whatever else, or airplane company, like of course it doesn't make sense. But
it's also important to note that every single one of those companies in that stack are racing to make electric vehicles as quickly as possible. Like VW, I think is trying to get there in 4 years. Or by 2030, I forget which, but they are literally shutting down all internal combustion production very soon. GM, same deal, right?
Yeah, and the traditionalists out there will say competition is coming to the electric vehicle market, and so they'll say, okay, so then that means that Tesla has a lead, but then these other competitors come in and then they take market share from Tesla.
Right.
That would be the traditional way of looking at it. If you think from a finance perspective and think from the perspective that all else being equal, these guys just kind of enter the market and they just take share.
Right. So and it squeezes Tesla's margins, right?
That's what they think. But what they don't understand is that in many markets, and this is in some markets, you have to think about what are the basis of competition in various markets. What is the advantage of scale? What are the advantages of technology? Because sure, if you're making widgets and somebody else comes in and makes a widget, then they'll probably gain share, especially if you undercut them on cost.
Right.
But what these bean counters don't understand is power law distribution, impact of scale, and the impact of data, in the aggregation of data and having a data advantage. These things that you can't see in underlying technology, the bean counters, the traditionalists, the Wall Street analysts that are used to like moving numbers around in Excel are never going to understand that. And on top of that,
let me quickly run through what a power law distribution is.
Sure. Please.
In case you don't know. So in the traditional world, bean counter world, right, that you're talking about, you might say that the number one company, it's better than the number two company, but it's, maybe 1.5 times to two times as good. And then the number three company might be 90% as good as the number two company. And the number four company might be, 90% as good as the number three company. So you get kind of like this fairly linear looking curve when you rank order the companies from like 1 to 10 to 50 and so on, right? If you were to line them up and decide, well, how good are they? What are like how do their advantages stack up? It would look, like a curve, but a pretty gentle curve, right? It's not like number one has tremendous advantage over number two or so on. Power law distribution, number one could be 50 times bigger than number two, and number two could be 10 times bigger than number three. You get this incredibly steep drop off. And then what's called a long tail, where everybody else literally doesn't matter. The area under the curve is concentrated in just a handful of the top players. And then there's other people in the market, but like it literally doesn't matter what they're doing because they're insignificant. So that's what a power law distribution is.
Right. So when we look at the ARCS model, so they're expected value is $3,000. This is a base case. The both cases $4,000. Now, what that essentially amounts to is roughly, market cap and share price are roughly in line. So, so $1,500 share price would mean $1.5 trillion in market cap. And this is also something that I would encourage a lot of the viewers out there to start thinking about is like share price itself is meaningless, right? So you should always be thinking in terms of market cap. What is the market cap? And then based on the market cap, for the potential markets that a company may be entering, what would be the potential growth of this company? Does this company have the potential to become from a $3 billion to $30 billion market cap company, or a $30 billion to $300 billion market cap company? But if you're thinking about growth companies, technology companies, you always have to be thinking in terms of what is the potential for growth from a market cap perspective. And again, understand that share price is essentially meaningless, right? It's just a number. And so one of the things that they'll talk about, and we can kind of do like a high level summary of this is that maybe kind of cutting to the chase here is that when we look at ARK's 2025 estimates, that they are expecting a lot of the market cap, the market cap contribution in 2025 coming from robotaxi, right? So almost half of the market cap for them is coming from robotaxi. So that's one thing when we talk about the assumptions and talk about how people value companies. And by the way, we should probably close the loop on that as well. But here you can see that because ARK is doing actually a good thing, which is that they are capturing also the potential for these future markets. They're not just comparing Tesla to GM, Chrysler, Ford, these existing companies in an existing market of selling electric vehicles. They're saying, hey, here's this big new market, and we're going to try and characterize this new market and give Tesla market cap credit for this new market of not only electric vehicles, but robotaxi and insurance, and this thing that they call human-driven ride hail. And this is basically just a scenario in which if full self-driving isn't there, they think there's like this potential transitionary thing that happens.
Okay, let's break this down because I like the bull case. I'm long Tesla, but I want to really understand what the hell is going on here. I'm seeing a lot of purple, and purple is connected to something called robotaxi. What do they mean by robotaxi?
So robotaxi means in a world where you have full self-driving, so everything's automatic,
right? And this is a feature that actually exists, right? You can buy a Tesla with so-called FSD, full self-driving capability right now. Is full self-driving actually full self-driving?
It is, although it sucks right now. I mean, you could go to YouTube and look at the videos. It's like cars stop like 6 feet away from like the crosswalk. I mean, all sorts of weird things happen. But here's the thing, the way that they're implementing full self-driving with machine learning, the more data they get, you're going to start to see, and again, this is the thing with technology, right? The more data they get, this thing is going to exponentially learn. And the more data they get, the faster it's going to learn, and the bigger the gap is going to be between them and other competitors. And so full self-driving is going to be a situation where you have full autonomy of your car. If the car is autonomous, then even when you're not driving it, then you could essentially have your car go out and give other people rides like an Uber, but it's fully automated. And when you eliminate human drivers, then that also gives you the potential to like add margin, add value where you didn't have that before as well. So it is a very, very important capability, and also a capability that has a lot of baked in optionality, meaning once this thing is out there, this capability, it's not like we've thought of all the various use cases for it, right? There might be other applications that are there that we just haven't thought about. So that is the robotaxi issue. Now, just going back to, because I realized we didn't close the loop on valuation, but so three primary ways that you can do valuation. We talked about discounted cash flow. which is this guy, where you kind of think about the future cash flows. And so you try and discount based upon risk, the free cash flows of companies kind of in the future.
Good for utilities, bakeries, stuff like that.
Yeah.
Maybe not so good for Tesla.
The second thing that you can do is you basically have some kind of financial model, and based upon your model, which is generally based upon some form of, assumptions about various margins, revenue, things like that. But you then try to say, in the future, how do we compare this company against an existing competitive set based upon a multiple against a key metric? Now, that could be price earnings ratio, right? So like, what would be the PE ratio of this company in 2025 or 2030? Then you try to estimate what the earnings are going to be and so forth. You could do it on, it could be an EBITDA multiple. It's some multiple against a financial metric that you assume the company has, and you get that multiple based upon a financial model that you build. But generally speaking, again, the assumptions that you're probably going to build that financial model against is a model against existing markets. Or you could try and kind of model in like robotaxi and other things. But I'll talk about some of the limitations to that thinking based upon a lot of the traditionalists, right? Because one of the things that we find is that when a lot of the bean counters make those models, even when they try to think about robotaxi or other things like that, that they fail to estimate the growth, right? Again, market timing is generally impossible.
Yeah.
And generally speaking, for big new markets, humans tend to underestimate scale because human beings think more linearly rather than exponentially in nature. Now, the third way of doing a valuation is what ARC is doing. And so here, what do we see? So what ARC has done is they've put a number of assumptions into the spreadsheet, and then they've outlined a bear case and a bull case. Now, what does this mean? They describe it here. All variables are modeled as normally distributed, with the bear and bull case bracketing one standard deviation below above the mean. So you have a normal distribution. You have, you assume a normal distribution, and basically their bear case is one standard deviation below their expected mean value, and their bull case is one standard deviation above their mean expected value. Now, I do have a problem. Okay, so wait, let me fully explain this. So now they've got all these variables, and then all these variables are put into their financial model and drive the output. So if the gross margin changes, how does that flow through to the valuation of Tesla? If all of these different variables change in these ways, what does that do to the valuation, right? And it's a random distribution. So what are they doing? They're running simulations. This is the Monte Carlo analysis. This is the third way.
Monte Carlo casino, right?
Yeah, this is the third way of doing evaluation, which is like is to say, okay, here are all these variables. Here's kind of the distribution in which they could change. Now, let me run a simulation. Okay, so you randomly pick a value for this variable, this variable, this variable, this variable, this variable. And then you see, okay, feeding all of that into the model, what does Tesla's valuation become? And they literally ran it thousands of times until you get to statistical significance. And then they said, okay, so then running it this many times, you get some kind of distribution in terms of what would be the target price.
And there Tesla. It is. Look at
there
that.
It is. There it is. Yeah, that's the output of the Monte Carlo simulation. And so now I would argue, though, that these variables are likely not normally distributed. They're probably distributed in some other way. Like full self-driving is probably, that distribution probably is more like, piecewise linear or something like that. It's some other distribution that depends on other things.
If you look at the probability of robotaxi's launch in this actual model, they've modeled it as a binary distribution or binomial. Like it's either it works or it doesn't. And the bull case is 50%. So
yeah, well, and I would say that like, right. So, I mean, okay, so I would say there are probably limitations with this model, but I would also argue that this is a better way of doing it than like a traditional DCF. Now,
it might be. Yeah, like, look, I haven't looked under the hood of this model, but speaking as somebody who did a dissertation in computational modeling,
yeah,
I think your point about drawing from normal distributions is probably correct. And I also have concerns about collinearity between some of these,
right.
By which I mean, some of these variables must be correlated. And again, I haven't actually looked at this particular model, but it seems to me as though they're being treated as independent random variables. And if so, that is crazy and probably wrong, because it's going to result in a bunch of edge cases that would never happen in the real world. Is basically the problem there.
Yeah, although I guess I would defend ARC a bit in saying that I think that at least it's simple, right? Relatively simple in terms of how they're, and, you know, and again, I do think it's superior to the way that some of these other guys are doing stuff like DCF.
Look, like DCF, as we talked about before we started recording, is actually a probability model as well, right? And what they're trying to get at is they're basically trying to predict the future from the present. And that works really well when you're quite confident that the future is not going to change very much from the present, right? They do the discount because you can assume it's going to change a little bit, you know, and you can take, you know, you could basically assume that it's going to change in a way that's not in your favor, which is basically what they seem to be doing there. That's why it's discounted. But those are assumptions too, right?
Yeah, I guess. Yeah, I guess what I would say is that when you're running a DCF, one, it's very hard to predict what the revenues are going to look like, and it's just, and I think that the way that a lot of these guys think when they're estimating the future cash flows is based upon existing markets,
right?
Existing competitors,
right? Well understood markets too, right, that are probably saturated, or if not saturated, then like they're on a growth trajectory that is well understood. Right. Yeah, I agree with that.
So, and then in terms of like, you know, ARC's thinking, I think that's the other thing that we could talk through with respect to, you know, the note that they had put out, and, you know, we'll add these links in the show notes, but I want to talk through how ARC is thinking. And then Steve, it'd be great to get your feedback as well in terms of how you think about this. But I kind of, so for me, again, as a lazy investor, investing by proxy, I'm just trying to think from a high level framework, right? In terms of how are these people thinking? What is their high level thought process? And so I kind of broke it down in these ways. And so when I think about EV scale and just reading through ARC's note, I kind of broke it up in terms of, well, when we think about how far can electric vehicles, that business scale, I would think of it in terms of supply, in terms of demand, in terms of the margin, and in terms of the value or ASP, average selling price, that you can extract from customers. And so when we talk about supply, you know, we can look at the sort of CapEx spending that's been growing fairly significantly. ARC, and it may be hard to see the text here, but ARC is estimating that in 2025, they'll have 5 to 10 million vehicles.
You can probably zoom in.
Yeah.
There you go. Nice.
Yeah. So ARC is estimating 5 to 10 million vehicles. So what does that mean? Well, Giga Shanghai at full scale should be able to produce about 500K vehicles a year at full capacity, meaning to get to 10 million vehicles a year, you're going to have to get, you know,
20.
So, I mean, and then, you know, look, and so for me, again, I'm not trying to go into the weeds on the analysis, but I'm trying to understand the assumptions and what you need to think. So then, you know, I think for me, it's like, you know, how many gigafactories do I think that they would be able to bring online in a you know, reasonable amount of time, or even in an unreasonable Elon Musk timeline, what would be possible?
In an unreasonable amount of time. Yeah. Well,
but I will say they got Giga Shanghai up really fast, right?
Yeah. So they've got 2 running. They've got Fremont and Shanghai. They're building another 2 right now in Berlin and Texas, right?
Right. Now, can they go up to 4 after that and 8 after that? I guess it's
geometric,
feasible.
right? Yeah. I don't know. It depends how much money they're making, right?
Yeah. The other thing, just kind of reading through some of the other notes, is that, one of the things that Elon Musk noted was that they're going to need a lot of batteries. Right? So again, I'm probably not going to go into the weeds on that, but I will try and note when people talk about batteries, whether that's an issue or not. And the other thing that worries me from a supply perspective is, I don't know if you saw the news about the Suez Canal.
I did.
But then, the price of nickel and access to nickel and what that has to, what the potential impact of that would have to do on cost.
Yeah.
And then would things like that drive up the cost of the electric vehicles?
Right.
The next thing that I think about, so now we have to think about supply, then we think about demand. And the biggest thing, in my opinion, is going to be demand in China, because I think that Tesla will likely have access to most other markets, but they could get blocked in China. And what we've seen, and Steve and I are in the mobile gaming business, but we have seen a number of occasions where it's literally just not. It's not a level playing field at all. And so to be potentially just blocked off and just have your business taken away from you is literally a possibility in certain markets, especially if you're trying to enter China.
Yeah.
So like right now, like some companies are given full access to China, right? Apple, for example, I don't see them. It's not really the government that's preventing the sales of Apple iPhones in China. It's more that there's a pricing, and that there exists a pretty healthy Android ecosystem in China. But iPhones are also selling extremely well in China. And so I don't know if Tesla in China will be considered more like Apple, or will it be considered more like a company like a Google or Facebook or other company. And by the way, those are more information related companies. So I think the government cares a little bit more about those. But I just don't know. And so that's one of the things I would worry about. And as potentially the biggest market for electric vehicles is going to be a key driver for Tesla's value in the future. And if you have any thoughts on that, Steve.
I do. Yeah. Like, to whatever extent you believe this thesis that the world is splitting into 2 rival armed camps between China and the United States. And I think we're still in the early innings here, but there's a good chance of this happening. Cold War II electric boogaloo, right? Certainly the Biden administration has done nothing to reverse that. And sentiment seems to be bipartisan in the United States against China, and more specifically, the Chinese Communist Party. Certainly within China, the Communist Party's line is that the United States is a declining power. It's China's time to rise, and the U.S. is going to do everything it can to keep China down, which is why we're hearing a bunch of noise about issues in Xinjiang, in Hong Kong, and so on. So there is major geopolitical friction brewing. It's already started. You're right that Tesla actually has done very well in China to this point. It's still early innings. They've only been there, I think, 3 or 4 years, something like that.
Yeah.
If even that long. But they are currently the number 1 seller of electric vehicles in China. And China is the world's number 1 market for electric vehicles. And it will probably continue to be in the future just because of the size of the market, 1.4 billion people. I mean, Europe, the EU, and the United States together cannot match that or even come close. Now, when you talk about people that can actually afford a Tesla in China, that's a little bit different. And when you do that calculation and you make certain assumptions about how much wealthier China is going to become in the future, then I think it becomes a little bit closer, but China is still number 1. So access to that market is really important. Obviously, Tesla is an American firm, right? But Elon Musk and Tesla seem to have the support of the Chinese government at the moment. That being said, there are major domestic competitors within China. There is a firm called NIO that makes EVs in China. It's a Chinese firm. they're doing things differently than Tesla with respect to how their cars are refueled. So Tesla has concentrated, as you know, on the supercharger network for re-upping your battery charge. And NIO actually has opened up a bunch of kind of like service station-like businesses in and around China's major cities, whereby you can drive your NIO car into this little kiosk, have it lifted up on a hydraulic press, and a robot switches in a brand new battery pack into the car. And Tesla actually evaluated this technology. They kicked the tires on it in 2013 and decided it would be a better idea to forego that opportunity and go with the supercharger network. And there are more superchargers in China than there are NIO battery swap stations at the moment, which is an important data point. But for whatever reason, NIO considered the same opportunity a little bit later. It's been around since, I think, 2016, as opposed to Tesla being around since 2010 or something like that, right, Joe? It decided to go in a different direction. And I don't know if that's specific to the Chinese market and will enable it to outcompete Tesla there eventually, or if they just have a different idea about how this market's going to evolve. I don't know. Yeah. But again, like, I don't think it's a good idea to bet against Elon Musk when it comes to engineering systems at scale like this, right?
Yeah, the way that I would model that personally is to just assume a certain percentage chance that they just get blocked or limited from the Chinese market.
I think so.
Yeah, that's how I would model that. But yeah, so, this is definitely a risk.
Big risk. Yeah, because if we get straight up like Cold War II, then most, if not all, American companies could get expelled from the Chinese mainland, you know?
Right.
And then basically Shanghai, the Gigafactory Shanghai goes from a major asset to like a sunk cost, a big one.
Yeah. The next thing to think about is margin. And the key thing to think about is cost decrease. Now, ARK has based their cost decrease model around Wright's law. And what Wright's law essentially states is that, and this has gone, I mean, there's been study of a lot of like, airplane manufacturing in the past and other things like that. But what it assumes is that once you double production, you generally tend to get about a 10% decrease in the cost. Just so scale efficiencies essentially. And so you're able to reduce your unit costs based upon learnings and things of that nature. Now,
economies of scale, right?
Economies of scale and just learning economies and other economies, whatever it is.
Yeah.
And so that's just kind of captured in Wright's law, right? So that every doubling of capacity, 10% reduction in cost. And, one of the things that seems to support this thesis is just Elon Musk himself announcing on Battery Day that there's going to be a 25K EV in 3 years.
Yep.
And there's notes also, there was mention of a new battery cell, which 5 times energy, 16% more range, 6 times the power, and things of that nature. Now, there are a lot of people out there who are shitting on this assumption by ARK and saying that it doesn't make any sense. And they're actually comparing it to, like this guy, why ARK's use of Wright's law is so wrong. But when you kind of like read through the thinking, honestly, it doesn't hold up. And I think they just don't understand, right? What's happening. I actually think that Tesla may be able to even get ahead of Wright's law because they're doing things that other companies aren't doing. For example, they're becoming fully vertically integrated. They're going to go in and figure out how to do things better across the board. Now, Elon Musk calls this, forgot what he calls it, but he calls the way that other car companies do it catalog-based manufacturing, meaning that you've got all these catalogs of things and you kind of pick stuff out and you put a product together, but then you're having to deal with the limitations of these disparate parts that you're ordering from this catalog to put your car together. Whereas they're able to create, because of the vertical integration, this has been the Apple model as well.
Exactly. Yep.
You're able to make things fit more seamlessly together. You're able to design efficiencies. And because not every company thinks about their processes as carefully and as carefully and as aggressively as Elon Musk does, right? And so you should expect that every component, every area that Tesla enters, they're going to have some of the smartest people in the world removing efficiencies from those processes.
Inefficiencies.
Removing inefficiencies. Sorry. And then the last thing to think about in terms of, again, we're talking about EV scale relative to ARC's model is the value, the ASP, right? And so I think that there was some talk about full self-driving being.
This is the big one. This is the robotaxi thing. This is what accounts for more than half of their valuation in the bull case, right?
I would call this it's slightly different. So full self-driving, I would consider in two parts. One part is you just get fully autonomous driving for yourself. Right?
Sure. Yep. Okay.
So then you can pay a subscription for that, or you can pay $8,000 just to buy it or whatever. And
it's gone up. I think it's 10. But
is it 10? Okay. Yeah. So and when people talk about and when you compare Tesla to other car manufacturing companies, but they're selling this $10,000 additional piece of software, right?
Right.
I mean, again, this is where like the traditionalists, they're just like complete idiots about this stuff where they just don't understand, right? And so then I think about the average selling price of cars, the ability to add additional value and a piece that's actually not hardware based, but is more software and services based. And for this, ARC thinks there's a 50% chance by 2025. Just to be fair, Elon Musk has tweeted before that he thinks this thing is going to be ready by Q2 of this year, which would be, a massive, like if that gets announced, you better, the stock's gonna jump, right?
Yeah, I personally think that's BS, but we'll see. I mean, it would be cool if it wasn't because I'm a long Tesla, but
yeah, I actually think there's a good chance it might happen this year. Just because because if they open up the beta, they're going to start getting a lot. I mean, I'm so happy that there's all these YouTube guys showing all these shitty videos of full self-driving failing. People don't understand that once you start getting massive amounts of data in, software improves very fast. It's not like hardware. You can't think about software like hardware.
It does. It does improve very fast. I'm just going to say two things. Number one, full self-driving, even if achieved, is not legal.
Okay.
I just want to underline that. I don't think any state in the country, with the possible exception of some jurisdictions in Arizona, allow level 5 driving at the moment. That's number one. That's more of a bigger deal than you might think to deal with all that regulation.
Right.
Number two, there are a lot of people working in the autonomous driving space.
Right.
A lot of smart people. Elon Musk's way of solving this problem is not the only way.
Yeah.
And very, very, very intelligent people who specialize in this sort of thing are not sold on his approach. He's done a lot of things very differently than
LiDAR being one of the big parts.
Yeah,
right?
Not using LiDAR, using cameras instead of LiDAR in an effort to accelerate that data curve that you were talking about. Because LiDAR is too expensive, although it's becoming much, much cheaper. It was too expensive 10 years ago, right? When he started thinking about all this stuff. LiDAR allows you to see much, much further ahead than cameras do, or human eyes for that matter. If the objective is to be as good as a human driver, then training your neural network with human drivers makes sense. If your objective is to be better than human drivers, training your neural network with human drivers doesn't make very much sense, especially if you're using cameras instead of LiDAR. So that's all I'm going to say about that.
Yeah, although I would say that, honestly, I would argue that even training with human drivers, because I mean, the number of idiots out there, and I include myself.
Idiots driving Teslas. There are a lot of them.
Idiots just driving, right? Whether you're drunk, whether you're drunk, you're tired, a lot of accidents happen, and, people are constantly on their cell phones, and just I have no doubt that that full self-driving is going to dramatically reduce the number of accidents and of deaths. I mean, it's just not even a question for me.
It has that potential. The question is, in order to overcome resistance, regulatory resistance, and like popular resistance, just people being scared of self-driving cars driving themselves around and like potentially killing people. Right.
No,
like,
I'm more scared of humans personally, but yeah, maybe I'm in the minority.
Well, no, you should be statistically. I agree with you, but people don't think statistically, right? They think imaginatively. And like human beings, like it's like plane travel is much, much safer than driving on the freeway, obviously. But most people would rather drive on the freeway, and they think it's safer because they see an air disaster. And it's just like, oh my God, it's so frightening when people die on the freeway every single day with regularity, right? So it's like, is parity with like even good human drivers sufficient to get full self-driving over the popular support hump and the regulatory hump, or not? And like, that is a really, really serious question for full self-driving, if you ask me.
Right. No, I agree. So the other area to talk about is insurance. This is the other thing that ARC had modeled. Basically, insurance just makes a lot of sense. Now, this launched in August of 2019, only in California. But when you think about it, Tesla in this area just has massive advantages in terms of, they've got access to real-time data. They can create a novel, they can create like a mile-based model usage model like that SPAC that recently went out, or, they have better data scientists. They have better everything. They can create a better insurance product. And by the way, similar to the car, no marketing costs. As soon as they sell a Tesla, that could just be an additional check mark. Oh, I want to buy this much better insurance. Check, and you're done.
Yeah, I would love that. I would totally do that.
So there's that. I think that in addition to car insurance, I mean, once you're in car insurance, why not just keep going? You know what I mean? Like this is some of the optionality that exists with Tesla. Like they can move in a lot of different directions once they have this live. Also, ride hail, right? So we talked about, so ARC had imagined if you don't have full self-driving, maybe there'd be some form of human-driven robotaxi or something. I don't know what they're thinking. I didn't look into too much of the details of that. But then for the full robotaxi, then it's worth quite a bit of value.
Sure.
So that kind of goes over the key drivers for the valuation of Tesla, and at least on a high level, how ARC is thinking about it. And I'll include links to the note and the model. And I would encourage the audience, the few people that are watching us, to go in and look for yourself. But now I actually want to talk about something that I think that the other guys don't talk about, which is, why do I believe that Tesla is so much more valuable than any other company? And this is the operational part that I think that all, including ARC, all of these financial analysts just don't understand and they miss. So I wanted to talk about this aspect of it, which is the operational. I would say that there's two things that Tesla has a massive advantage in terms of operational execution and scale. And the reason why they have that, and I want to explain this concept. And so this curve here, this graph depicts what's called the technology adoption lifecycle.
Sure.
This was popularized by a book called Crossing the Chasm, a guy by the name of Jeffrey Moore, who worked at this firm called McKenna Group, a company I actually used to work at. But the idea is that there is essentially, for new products that are trying to enter the market, there's like this chasm. And when it crosses the chasm, it's now something that a lot of Silicon Valley people just call product market fit, that you're trying to figure out if a new product can get to the market, it hits the market, and then you scale that product up. and it starts to get adopted by more and more people, and then it starts to wane.
Once you achieve product market fit,
once you
that's when
achieve
you
product
scale.
market fit.
And
now,
fitting is tough, but yeah.
Now, Peter Thiel talks about this in a different way. He talks about, scale in terms of 0 to 1, meaning you kind of figure out this new product. So crossing the chasm is essentially like a rebranded version of 0 to 1, and then scaling it up is 1 to n. Now, I talked earlier about why a lot of analysts fail in terms of, like, for example, a lot of folks think in terms of very linear ways. And so when people are building their models, and I should just use a straight line here, when people are building their models, they are generally thinking in very linear terms. And so as you're going up this S curve and you're building your financial model, usually because human beings think very linearly, you're kind of missing a lot of value here. Generally speaking, this is what analysts do a lot for new kind of technologies and kind of new businesses, new markets, right?
Mm-hmm.
And so that's one of the things that you want to look out for when you look at the analysis of a lot of the existing bean counters, finance guys, these guys that are like, changing cells in Excel. This is generally the type of thinking and behavior that you're going to see. Mm-hmm. And so one of the really, really special things about Elon Musk and Tesla is I believe that this is one of the few companies in the world that can not only do 0 to 1, but 1 to n. They've been proving out their ability to scale by, increasing the scale of production of their electric vehicles, by building out new gigafactories. But they've also proven their ability to establish a new kind of product, right, in a new market. And generally speaking, and Steve and I come from the mobile gaming industry, and we've seen time and time again that the companies that are great at 1 to n, Zynga, in mobile gaming, like companies like Zynga, Playtika, these kind of companies, they become terrible at making new games. And so they go out and they acquire games. They're great at scaling. They're terrible at 0 to 1.
Right.
And this is often called the innovator's dilemma, that the companies that actually then become very successful here are not able to jump to the next S curve,
right,
because of this inability of doing both 0 to 1 and 1 to n.
They're different types of organizations, and if
They're
you have
different
a larger,
types of, that's right.
If you have an organization that's built around operational excellence and basically gaining efficiencies at scale, right, that's a completely different type of problem set than figuring out something from the ground up and being creative, right? Yeah. It's different personnel, it's different management. You almost need like a little startup inside of your established organization, or as you said, your established organization needs to go out and buy startups, right? Right. Now, so in my view, Tesla is one of the few companies in the world that can do both of these things in one company. In one company. So Amazon's probably the only other company like that out there that I can think of. Right. And so what is Apple conceivably, right? Apple's done it post for a while. Steve Jobs. Not so much. I think they will. I think they will scale a finance product like a, expanded credit card type product in the future. Yeah, I think they'll get there. I've been waiting for a TV product. I think, since Steve's gone, we haven't seen it. Who knows if we'll ever see it. Augmented reality, cars, we'll see. Right. We'll see. But so I think that, a few key concepts to note in terms of when you think about companies and scale is the following. So the way that I think about these kind of companies there are companies that are good at 0 to 1. Mm-hmm. There are some companies that are great at 1 to n. Mm-hmm. And then there are companies that are great at A through Z, meaning you can do this, but you can actually you can create new markets. Mm-hmm. And you can go after multiple markets, right? And a company that can do that has infinite potential value. Mm-hmm. So like Tesla, like they can go into the electric vehicle market, they can go into the energy market, they might go into the robo-taxi market, they might go into the airplane market, they might go into a bunch of different markets, and they're one of the few companies in the world that can actually do that. And so I think that is a source of so much value
that is currently being discounted by the market, because I don't think that these bean counters understand how big companies operate. The politics in big companies, the way that people think, the level of inefficiency, right? And I'm talking massive inefficiency. I'm talking terrible work cultures. I'm talking things that, again, working as a financial analyst, like you're a business school student working at JP Morgan or some other company and trying to, you don't know how a company actually works. You're not going to be able to model this kind of stuff. And this also reminds me of a story that Vinod Khosla related about when he first started. Vinod Khosla was this guy who started, he was one of the founders of Sun Microsystems, an old like workstation company. And he talked about when he was first starting Sun, there was a guy who had some key technology around a workstation, the guy by the name of Andy Bechtolsheim. And he tried to convince Andy Bechtolsheim to join him. Andy Bechtolsheim was a Stanford grad student at the time. And he's like, nah, just license the technology from me. But I need to finish out my PhD at Stanford. He had another 6 months. And what Vinod Khosla told him is, I don't want the golden egg. I want the golden goose that lays the golden egg.
Yeah.
And so what we're seeing today is we're seeing a lot of companies that have golden eggs. Tesla, and this is something that's very critical, but so many people just do not understand. Tesla is one of the few companies in the world that has a golden goose that can lay golden eggs.
That's Elon.
That is Elon and all the things that he has built at Tesla. Yeah. And so what I would think about then is, so when you think about that, so what is this golden goose optionality, right? And this is what, when a lot of these bean counters don't understand, but they know that sometimes companies, and they don't really understand how, but sometimes companies will add a new business somehow, and then it'll add value. And then they just say, well, we'll just call that optionality, right? But the golden goose optionality for Tesla could be when full self-driving is fully manifest and that technology and capabilities out in the market, there's just going to be things that we haven't thought about that can enable new markets. Other things can just kind of pop up that could be enabled. Mm-hmm. Commercial transportation, right? Like all of the shipping, the driving for all of these big companies, whether it's like Pepsi or Coke or like, garbage disposal for the government, or like there's so many things that could happen, especially like who else will be able to handle garbage disposal? And I would say that having machine learning is better than LiDAR if you're trying to make a robo garbage truck, you know what I'm saying? Mm-hmm. Electric airplanes, which Elon has talked about with Joe Rogan. He's like, oh yeah, I should probably do that. But then he's like, maybe another time. If Tesla and FSD run out of steam, he'll just add something else. There's already the Hyperloop business, but I don't know, maybe he'll just do like with Solar City and acquire that and they'll scale that up too. I don't know. E-commerce, there's this YouTuber named Dave Lee who talked about this concept of last foot delivery, meaning that once you have robo-taxis, the other important part is not only getting stuff to someone's house, but potentially entering the e-commerce category by having robots that can also take packages and go from the car to the door. Finance, so when everybody...
To be clear, you're talking about robots being driven around by other robots right now.
Yes.
Okay, sure. Please continue.
Yeah, well, not being driven around. Yeah. Yeah. So, when you talk about, I think there's been some rumors that were leaked about how Elon might open up the electric charging stations to other car manufacturers, right?
Yeah.
But in order for them to do that, they'd have to download the Tesla app. Uh-huh. It's like, what happens when everyone has a Tesla app?
Anything.
Yeah. Anything. What has WeChat done in China? Exactly. What in terms of like, so super credit app. Card payments? Yeah. Elon's been supporting Bitcoin, but he's also been pushing Dogecoin. But why not a Doge? Sorry, Doge. But why not a Tesla coin? So again, the reason why I don't, the thing that I think is not captured and is hard to model is just what I call the A through Z scale, the golden goose optionality that's fundamentally baked into Tesla because of Elon, because of the culture, because of the way that they're structured, that no other company has.
Yeah. So this is the idea that Elon Musk is not a business person in the real world, like we've seen before. He's not Steve Jobs. He's not even Thomas Edison. He's Tony Stark.
Right.
It's kind of what you're saying.
Yeah.
Right. In the movies, he's Lex Luthor, except hopefully not evil. Right. He's he's going to Mars and building stuff on Mars. He's doing supervillain type stuff. Right. Again, except hopefully not evil and good for the world and very profitable for stakeholders. But it like he's one of these guys that comes around every 1,000 years or something like that, right?
Or I mean, I would actually argue that yes, Elon Musk is super rare, but with advances also in education, I think we're going to see more Elon Musks.
That's a great point and a wonderful thing to think about.
Right.
It might just save our ass, right?
Yeah. Well, we're going to need it.
Yeah.
But the one other thing I wanted to talk about with respect to Tesla is something that I also call structural advantage. And this is the other thing that, again, the bean counters, the finance guys, these analysts just don't understand unless you've actually worked in the industry and worked at big companies, small companies, startups, experienced different kinds of environments. You just don't understand. You can't put that into an Excel model, right? And so let me talk about this concept that I personally call structural advantage. Mm-hmm. And the funny origin behind how I started thinking about structural advantage is actually because I'm a fan of college football. And a guy by the name of Chip Kelly, when he first became the head coach at Oregon, I was like, who is this guy? And he was doing things so differently that it just blew my mind. And so I was like, I have to find out more about this guy, right? And then when you hear about his offense, how do you compete if you suck at recruiting, mm-hmm. and you've got 3-star athletes coming into Oregon at that time? Now they get everybody, right? But at that time, you got 3-star athletes. How do you compete against teams that have 5-star athletes? Well, I mean, one of the things that he did is he conditioned the shit out of his guys. And then he's like, you know what? We're just going to run like go patterns and just tire out the defense. You know what I'm saying? Right. And then what else? The zone read, he came up with all of these systems. I won't go into the details of it because that's probably too off topic.
That's a different podcast. Here.
Yeah, that's a different podcast. And we can't go into the weeds on that if people are interested. But structural advantage means you're building a way in which you're operating that is fundamentally superior than competitors.
Right.
Tesla has this. And let me explain to you what kinds of structural advantage that Tesla has. So first, it comes down to one, just being a mission-driven organization. I think people fundamentally underestimate what does it take to motivate people to do great things, right? It takes having this notion of mission. And Tesla is quite arguably the most mission-driven company in the world, right? If you're an employee at a company, you want to feel like what you're working on is purposeful and important. And Elon does a great job of saying, we're actually trying to save the world here, and people get it, and they're compensated well for it, right? Mm-hmm. And in terms of communication and politics, Elon's famous for sending this email out about this kind of issue that happens at a lot of companies, right? It's like, I have my team, you have your team. Don't talk to my guy because, I want to control the information in my group and I want to hoard power and stuff. And Elon sent an email that basically said, look, information flow is going to go as directly as possible. If you try to block someone from talking to anybody else, you will be fired.
Right.
And so the organizational efficiency of this relatively big company, where you typically see inefficiency, which I would say would put companies like Toyota, GM, Ford, and I would estimate 30 to 50% operating less efficiently because all the bullshit, the politics, the information hoarding, all the this and the that happens in these large companies. you have structural advantage. So you have a mission where people are going to be motivated to work more at the company.
So this is a really interesting idea, this idea of structural advantage, because the three companies that you just named as having structural disadvantages in their day actually did have major structural advantages. Ford invented the assembly line, right? 100 years ago. GM, I'm not exactly sure what they did, but they were incredibly succuseful. They built a lot of tanks in World War II. I know that. And then
Ford's a great example. And when you talk about the advantage of, comparing, the automobile at the time versus horses or something like that. Sure.
Exactly. And GM, became a defense contractor, built all kinds of things besides cars. And at one point was the world's biggest corporation, right? They must have had structural advantages too. I just don't know enough about GM to say what they are. Toyota had the idea of
Kanban,
5 Sigma,
efficiencies,
4
production
Ys,
efficiencies,
all of these things, right?
They had structural advantage for a time. Toyota
so what
did,
the point that I'm getting at is that structural advantage is contextual, right? And it is tied to the time and the place and the product, the industry that you're dealing with. These are all car makers, right? It's all the same industry, sort of. But the argument we're making now is that the car industry actually isn't so much the car industry anymore. It's the transportation and energy, data, and who knows what else business, right? And so all of these structural advantages that stood those old companies in good stead during their time to shine are now holding them back, right? And Elon Musk has come in and done it again with Tesla. I think it's a compelling argument. But it's important to recognize it's specific to the context of what's happening right now and what needs to happen right now, right?
Yeah, well, So I think if your point is, will Tesla continue to have structural advantage?
Yes,
20 years from now?
Yeah.
I don't know.
Doesn't matter. I don't know. Because we're talking about 2025, right?
Well, I'm a long-term holder. At some point when they lose structural advantage and when they lose these other things, that's when I have to pick another company. Right? Yeah. That's when I have to then sell my Tesla. But for right now, I see a powerhouse. And when we talk about culture, that Tesla is mission driven, that they are organizationally more sound and more efficient. Mm-hmm. In terms of the leadership. We literally have the world's best CEO in Elon Musk, in my opinion. He's visionary. He's like product and engineering driven. You don't know how many people out there who haven't worked at these large companies, and it's like, what do CEOs and a lot of these senior VPs and execs do? They take meetings from 9 to 5 and go home.
They mostly talk to investors.
And they'll talk and they'll bullshit, and they've got all their little minions and underlings doing all this random crap. And it's like, they actually don't do quite a lot. And to be able to have someone like Elon Musk, who is actually more operationally oriented, to be able to effect massive efficiencies organizationally in a company like Tesla is incredibly rare.
Yeah, no, he's famously, during production hell, right? When he was trying to get the Model 3 out the door at scale and the company almost shut down. When was this? 3 years ago? Something like that. He was famously on the factory floor.
Right. He was sleeping on the floor. Right.
Or not sleeping, as the case may be. So that's pretty amazing, actually. I would agree with you.
I think the other thing from a leadership perspective is because he's Elon Musk, because of Tesla's market position, because of the mission and the stock appreciation, they're just going to have a talent advantage. Who wants to go work for GM or Ford with all the inefficiencies, with all the bullshit, with, when you could work for Tesla? It just doesn't make any sense. If you're the best in the world, you want to go where the other people who are best in the world.
By the way, this is exactly how that power law advantage accrues.
That's right.
Right. This is one of the mechanisms. It's called preferential attachment, which is basically the rich get richer. It's a very simple idea.
Yeah. And by the way, as much credit as I want to give ARC and, this is stuff that even those guys don't even think about. They've never talked about. Right.
Yeah.
Also structural advantage in terms of marketing. GM spent $4 billion in marketing in 2018. And and this kind of like, I just tried to look up some stats. So Statista for 2019 was saying that Hyundai, Lincoln, and Jaguar spend about $1.5K to $2K per vehicle.
Tesla spends zero.
Zero.
That's
Structural
crazy.
advantage. Structural advantage.
That's a major advantage, especially coming as we do from an industry where like you literally have to pay money hand over fist to acquire a customer, right?
Yeah, and go back and think about insurance.
Yeah.
Insurance. Now, if they enter insurance, they will literally whoop ass.
Yeah.
Because cost of customer acquisition in insurance is
sky high.
Everything.
Yeah.
Everything.
Yeah.
So, and then finally, in terms of efficiency, the vertical integration that we talked about, right? So Elon's model insourcing, kind of building out everything internally versus he actually called it catalog engineering. And the fact that we made the machine that made the machine that made the machine. That's a quote from him, right? Again, structural advantage. How are these guys, how is GM or Toyota, Ford, how are they going to compete against all of this?
They're not.
Doesn't make any sense.
They're gonna operate around the margins, right? And
yeah,
that's fine.
So this is like, in my view, I honestly view this like Tesla is like LeBron James competing against a junior high school basketball player.
Hey, where'd you get my photo from junior high, man? That's not cool.
This is literally what we're talking about. And so when you've got all these guys shitting on Tesla, they just don't understand. And so for me, my bull case as a long-term holder of Tesla, I think Tesla will be 10 years, $10 trillion. Part of it's from this stuff. And yeah, again, I'm kind of cheating because I think part of it's going to come from dollar debasement. but I think that for me, when I invest in stocks now, every month I'm putting a little bit of money in, I'm trying to think, who is better than Tesla? What is the best alternative? It's really, really hard, right? It's very difficult.
Yeah.
So anyway, I think we talked quite a bit about Tesla.
I'm sold. I was sold before you started talking personally, but maybe I'll go out and buy more. It's like,
I think so. At these current prices, I think so.
Yeah, man.
I think so.
If you're looking at 10x or more in 10 years,
yeah,
it's a spicy meatball, $6,000 a share. I like it.
All right. Well, anyway, folks, hope you found value in our discussions today on Tesla. We're going to try a bunch of different things, but yeah, let us know if this is useful.
Yeah.
Or
like,
you can
comment and subscribe. Even if you think it sucks, comment.
Yeah. You can give us a throw up icon.
That's fine.
It's all good. All good. All right. Cool. Yep. Thanks everybody. And
thank you.
That
Till next
is
time.
a wrap.
Yeah.